We have a quick question here from Sneer asking a little bit more clarity on how we can trade something like flash PMI numbers. Now, thanks for the question, Sneer. Now, we can answer this question by first taking a quick look at exactly what the flash PMI data is. Now, the PMI is basically just an abbreviation for Purchasing Managers Index. And the aim of the reports is to basically provide a monthly indicator across various parts of the economy, including inventories, output, inflation, exports, capacity utilization, as well as employment. Now, the reports are divided into different categories, namely services, manufacturing, composite, and also construction. Now, the reason why we care about the report is because it is considered as a leading indicator of business activity, and it's very helpful as it's released in the current trading month, the flash numbers. So meaning we get the flash PMI data for June already at the end of June. So it's much more real time compared to something like GDP growth data. Now, the report is calculated by basically asking survey-based questions to various purchasing manager index executives across various industries in each country. And the surveys ask them a series of questions. And it's a diffusion index, which means that it doesn't show us the actual output or the actual business activity, but rather shows us whether the surveyed PMI executives, whether they think business conditions will improve, stay the same, or contract for their various industries. Now, a reading above 50 usually shows that PMI executives think that the business conditions are expanding, and a reading below 50 usually shows that PMI executives think that the business conditions for their particular sector and industry are contracting. Now, even though the data doesn't have revisions like some other economic data points, it is split into two reports, namely the flash reading as well as the final reading. Now, the flash reading, as we said, usually consists is released at the in the current month for the current month, and that normally consists of about 85% of the total respondents for the surveys done. And that is often followed then by within 10 to 14 days with the final reading, which basically encompasses all the surveys collected. Now, of the two reports, the flash reading is usually the most important one and influential one that we want to be focusing on, as it's the first reading of the overall readings for that particular month. However, that doesn't mean that the final readings can't be important, and they can still be important and market moving if the updated final numbers show any massive significant jumps above or below the prior flash readings. So there's a couple of tips that can help you to trade these events better, especially the European metrics. For the EU, some retailers often only look at the European numbers itself, or the total EU numbers, and they disregard the German and the French numbers. But the French and the German numbers are released before the total EU numbers, and they are actually more important. France and Germany are the two biggest contributors to EU growth in terms of their share of total EU GDP. So a big miss or a big beat in the French and the German numbers itself can often dictate the overall EU total number to a large extent. So, for example, if we have a big beat in French data and that is followed by a big beat in German data, we'll have a very high probability that the total EU numbers will be a better than expected print as well. So when trading the EU PMI data, always start with the French data that's released first. Any big beat above the market's maximum expectation or below the market's minimum expectation for a miss can see additional movements in the euro. But after the initial move, we might see the markets take a little bit of a breather as we need to wait for that 15 minutes before the German numbers are released. Now, the German data usually either seals the deal for a miss or a beat across the board, or it can also sometimes muddy the water. So, for example, a big beat in the French data followed by a big beat in the German data will be a higher probability and higher conviction potential for upside in the euro, and vice versa. If we see a miss in both, there's a higher probability and a higher conviction potential for downside. Now, even if we get a big beat in the French data and that is followed by just an as expected German data, or if we have a big miss in the French and an as expected or vice versa, it can also create some opportunities. But the situation that you want to avoid is really where you get a big beat in the first batch of data, but a miss in the second. So imagine that you get a big beat in the French data, but a miss in the German, or a big miss in the French and a beat in the German. That's not really the type of data that you want to be trading, because you'll have a lot of whipsaw in terms of the price action. Now, as with any economic indicator, the data itself is important, but it might not be market moving based on the market's expectations for these particular events. So that's always important to keep in mind for whether you're trading the Euro PMI data, whether you're trading the UK, the US market PMI data. Always make sure that you understand the market expectations. So, for example, if an economy is currently in a growth or an expansion phase and the data is moving up steadily across the board, then one more good print or even one bad print might not offer any exceptional trading opportunities because the market will be expecting good numbers, if that makes sense. But if the economy is currently starting to show signs of slower growth and you get a string of negative prints for the PMI data, then that becomes a lot more interesting for the markets. Also, let's say that your central bank is currently in a cutting cycle, right? And it has cut rates a couple of times already. Then one more bad PMI data might not be, as market moving unless it causes the market to suddenly price in even more potential rate cuts or even more softer monetary policy. Whereas if the bank is currently in a cutting cycle and suddenly PMI data starts to surprise to the upside for 2 or 3 months in a row, that can start to cause the markets to rethink their current bearish bias on that particular central bank and might even start to reprice that the bank will need a lesser, softer monetary policy and might eventually start to lean more neutral. So the overall sentiment is just as important as the data itself. We always need to consider that in line with whatever data points we are trading. So Sneer, I hope that helps. For more information on the IHS, feel free to also visit their website, ihsmarket.com. They do offer lots of additional information on the website, lots of great releases, lots of additional information that you can read through, some reports on a daily and a weekly basis as well. So make sure to catch the website for more information on this particular data series. Any other questions, as usual, Sneer, don't hesitate to let us know.